Welcome into the reaction channel, folks. Hope everybody's having a great day out there as always. Got a few things to discuss here today, including I bought more AMD stock. We're talking about why I bought more AMD stock, why I'm adding to the stock so aggressively. I think that's the important point I want to talk about at the beginning of this video because I'm adding it very, very aggressively right now. So to see me adding this quickly in regards to a stock, there has to be something here. So I want to talk about that at the front of this video, okay? Then from there, I want to react to a few videos. Tom Lee, everybody's favorite bull, went on CNBC here today, talked about this is a big buying opportunity, and he even mentioned recently here in the past 24 hours that it's a back up the truck buying opportunity. So I want to speak about that, kind of give my opinions and perspectives there. From there, we're going to react to this one, the Professor Jeremy Siegel. He spoke about his views on this market. Palantir got another major contract, U.S. Army, so I want to go ahead and react to that one in this video here today, okay? Now, additionally, I know a lot of you guys probably are going to want me to talk about Nike's earnings because Nike earnings just came out. I'll likely talk about that on the main channel tomorrow. All I've got to see is their very base level numbers. Haven't gotten to go in depth, haven't gotten to listen to a conference call, any of that, so I don't even really want to talk about Nike yet. We'll address Nike tomorrow, likely on the main channel. So if you don't follow me on the main channel, it's called Financial Education. We're approaching 800,000 subscribers on that channel. So yeah, that will be discussed there. All I need from you guys here today, one thing only, for you to smash that like button for me, please. And if you want to be subscribed to the channel, you can subscribe to the channel. I think we're at, what are we at here? 65,000 subscribers, 66,000, something like that. So appreciate y'all for being subscribed here. Additionally, I'm going to shout out something I haven't talked about in quite a while is my Patreon. If you want to support my content as well as get access to see the stocks I'm buying and selling, my Patreon portfolio every single week, pin comment down there. You can click on that. Additionally, you have a plan. If you want to pay annually, you actually save 16% on that one. And yeah, that's the main tier that most people are signed up for. We have 1,240 paid members. So appreciate everybody for supporting on Patreon. And it's a great learning opportunity to get to see the stocks I'm buying and selling each week and exactly how I build up a portfolio, right? Amazon, by the way, I think this is worth mentioning. Have you guys seen Amazon? It's a sneaky one. Like Amazon, of the big trillion-dollar companies, Amazon kind of doesn't get talked about that much. Everybody's so always talking about Tesla, very caught up into Apple, in some of those sorts of companies. And Amazon's just a sneaky one. Now sitting at 100% gain in the public account on Amazon, $124,000. So that one's performing pretty tremendous, okay? AMD, what did I do here today? Why did I do it? Why am I adding the stock so aggressively? Let me address that, okay? So AMD here today bought another 75 shares. Yep, another 75 shares. I cashed out 2 contracts, toll put options. Those ones have just been skyrocketing in value. Like, it's insane how fast those Toll Brother put options are going up, right? And so I'm kind of using those Toll Brother put options as just kind of like an ATM machine for me right now and just kind of cashing them out. I got more contracts to cash out. I might do that over the next few weeks. We'll see, especially if Toll stock keeps going down. I thought I would hold that into 2025, but the fact that those contracts are just skyrocketing. I mean, Toll Brothers stock is just getting wrecked right now. I got to take advantage of some of that opportunity there, right? But AMD added another 75 shares. So now I'm up, I'm at 741 shares of AMD in the public account now at this point in time, right? And I'm trying to get to 1,000 AMD shares in the public account, hopefully by late January, early February. Once I get to 1,000 shares in the public account, I'm going to probably be good with buying more shares in the public account. That doesn't mean in other portfolios I might be willing to add some more AMD here and there after, I get to 1,000 in the public account. But for the public account specifically, that's a level of risk I'm looking to take on AMD, 1,000 shares. And the good news is I think I'm going to get there. And the reason being is I still have that ATM of Toll Brothers put options to continue to cash out here and put that money into AMD. And additionally, the stock's trading really cheap. And I mean, as long as the stock's under 150, I'm adding in more and more AMD. So the stock's so far from that, it's trading 119, 118 today, that it makes a lot of sense, right? Now, I'm also adding very aggressively right now. The reason being is AMD's earnings should likely come out end of January, beginning of February, right? I don't want to be in some sort of situation where people get really excited about AMD stock, it gets bid up. I'd rather get my position fully built out, at least in the public account, right, by the time earnings come out. That way, in case they bid it up after earnings and the stock pops 10, 15%, I already have my position built out at that time. If it goes down in earnings for whatever reason, I mean, I would probably even consider adding more shares of it, which, I'm not really planning on doing. My plan is to just get to 1,000 shares and hold in the public account, but we'll see. But that's why I'm adding so aggressively, because I've got to get the position fully built out before earnings come out there, right? And obviously we have tax loss harvesting going on right now. So in those sorts of time periods, I love to take advantage of this, right? My hope is we get more tax loss harvesting here into year end. And then my hope is Wall Street comes back, right, out of their vacation, their Christmas break vacation, right, New Year's vacation, and they put a bunch of selling pressure on the market for 2 weeks before earnings start dropping for all the different companies. And then, we could see AMD maybe $105, $115, something like that. So that would be my hope. I don't know if we'll get there, but let me answer this question. Could I see AMD stock go under $100 a share? My opinion is very unlikely. I would love to be wrong about that. I would love to give me AMD at $80 or $90. Are you freaking kidding me? Oh my gosh, give me every share in sight. I'll go way over 1,000 shares in the public account if that happens. But I think there's extremely low probability, and I mean extremely low probability, that AMD goes under 100. So, but I would welcome it, man. I would love that. Give me AMD at 85 bucks, 95 bucks. Oh my gosh. Come on. You guys know me. My long-term thought around AMD is that stock's going to be a $300 to $500 stock 3 years from now. So, if I can get shares at 80 bucks or 90 bucks, are you kidding me? The risk reward there is crazy. So I would gladly take that. Now, additionally here, you look at AMD, this stock's just inflected positive on a trailing 12 month when it comes to revenue. We've got several years of ramp on revenue coming for AMD. So, the fact that I understand a lot of these Wall Streeters might be in AMD at 200 bucks, 180 bucks, 170 bucks. So they're looking to tax loss harvest it here at year end. But I'm just it's wild to be selling this stock right now when we're just at the literally inning one of the inflection positive on trailing 12 month revenue. We've got several years of growth ahead for AMD. My opinion is minimum 3 to 5 years of major growth ahead for AMD when it comes to their revenues. 2030, what's going on with their revenue? I think that's a question mark, right? 2032, question mark. But for the next 3 years, I think it's pretty obvious to anybody that does some study on AMD, the company's revenues are going to skyrocket over this next few years, right? And then along with that, it's not just revenue is going to be skyrocketing, but you're going to see gross margins expand rapidly, net margins expand insane. Additionally, you're going to see the earnings per share and net income fly for this company. So, the cash flows are going to start pouring in. And then the question for AMD is, as those cash flows really start to build out, what do they do next? Do they try to acquire another company? Do they spend that money on share buybacks, dividends? This is just, there's a whole world of opportunity for AMD. So they're just getting through a drama moment for them in the stock market, but man, there's a lot of upside ahead in AMD. So much upside ahead. So I love that one. Alrighty. And by the way, where's the stock trading at on a forward P basis now? A forward P basis 26. Are you kidding me? We're inning one of the next major growth cycle for AMD. So the fact that this is at a forward P of 26 when you're in the first inning of a new growth cycle for AMD, that's going to be a multi-year likely growth cycle. That's crazy. I don't know any way to put it, but somebody that's buying the stock, thank you. Thank you. Thank you. That's just a whole lot more profits in the future for me. Markets dip a buying opportunity, says Tom Lee. Now, before we get into Tom Lee and what he said here, I want to address one thing. One specific comment he made yesterday. People shared this in my private group Discord chat. Tom Lee said, what happened yesterday? A back up the truck buying opportunity. Listen, do I view yesterday as a back up the truck buying opportunity? No. However, it's a buy the dip opportunity. But there's a major difference between back up the truck buying opportunity and a buy the dip opportunity. Buy the dip is there's good opportunities out there in the market, take advantage of those deals. Back up the truck is you could put money in almost anything and you're just going to make crazy money. A good example of back up the truck would have been the Rona crash, right? The Rona crash, you could have pretty much just bought almost anything and made a lot of money. Another good example in recent time periods of a back up the truck buying opportunity would have been 2022. Late 2022, You could have put money in just about anything tech related, Netflix, Shopify, Meta, Amazon, just run through the whole list of them, right? That was back up the truck buying opportunity because it was just like there was so much money to be made over the next few years as long as you were buying that opportunity, right? That's back up the truck. Great financial crisis, back up the truck. Those are very freak situations you have where it's just throw money out there and get ready to make 2x, 3x, 4x, 5x, 10x your money in a matter of 2 or 3 years afterward, right? Because the comeback when you start to get some buying pressure come in after just a relentless selling pressure for a year or two is unbelievable, man. It's unbelievable. So yesterday, buy the dip opportunity. Not a back up the truck. Like, let's be very, very. If yesterday was a back up the truck, you would have saw me put $500,000 in the market easily. Like, if that was a true back, it wasn't that. It was a buying opportunity, but it wasn't like, oh my gosh, this is going to be crazy. Come on.
And the Fed remains supportive. Our other thinks the Fed will be on pause for the time being and could even hike again if inflation reignites. Joining us for more is Tom Lee, Fundstrat Global Advisors Head of Research and a CNBC contributor, and Jeff Kilberg is founder and CEO of KKM Financial. He's a contributor as well. Tom, we'll start with you. I take it you think this is a buying opportunity.
This is another buying opportunity in our view. 2024 has proven to be a year where the market's been strong and it has eluded many opportunities for sustained weakness. I know yesterday's pullback was really painful, but to us, I think the fundamental supporting stocks are intact, and I think it's a good opportunity for investors here.
Painful? Who is it painful for? I'm really trying to figure that one out. Right? Public count yesterday was down like $150,000 or something like that. I don't even care. Who cares? The public count went back to where it was, last week? Does it even matter? No. Unless you just got in the market in literally the last week and you bought stocks. Outside of that freak situation, who cares? If your portfolio goes back to where it was the previous week, does it even matter? That's wild to me. That's wild. Who was feeling the pain? People are too emotional if they're feeling the pain from yesterday. Come on, man. You want to talk about pain? Go through the market in 2022. That was pain. When you saw the best tech companies in the world falling 30, 40, 50, 60, 70%, that's pain. That you're going to feel. The great financial crisis, that you're going to feel. The Rona crash, that you're going to feel. One day where the market drops to where it was the previous week is wild. That's not pain. That's just market doing what the market does. Come on, man.
A good opportunity for investors. Jeff, I take it that you feel is differently putting it too strong?
Well, I don't disagree with Tom on the fundamental side of it, but I think if you look at where we're at, with the interest rates, what's on the horizon from taxes, tariffs, and deficits, I really have to be considerate of what happened yesterday. It was the second largest move in the VIX we have seen. And historically speaking, Kelly, Tom is right. A month after that spike in the VIX, you see the S&P 500 higher. However, I don't think we can lean on history here due to the fact that we've seen stretched valuations in the top 10 names of the S&P 500. We've also seen...
Not true. That's a talking point I've already destroyed many times, okay? Look at the biggest stocks, right? Look at the big dogs. Let's pull them up here. Let's start out here with Meta, Google, Nvidia. This is not true. Look at this. How are you going to say Meta at a 23 forward P is rich or overvalued or a bubble or anything like that? No. The only debate you can make with Meta is a stock fairly priced or is it undervalued? There's no in between there. There's no is that overvalued? Are you kidding me? At a 23 forward P for a company that's growing, top line, bottom line, double digit percentage and should for years to go in the future, no. Google McDougal, 21 forward P for a company growing revenues and earnings per share 10% plus a year for years to go? No. Certainly you can't make an argument that one's overvalued. That's either fairly valued or actually undervalued, right? Nvidia, same exact thing. Forward P of 32 for a company that's growing, revenue and earnings per share, triple digits. And even next year is going to be strong double digits, probably 50% plus revenue growth and 50% plus earnings per share growth. No. So Meta, Google, and Nvidia, you can't make arguments that any of those stocks are richly valued, overvalued, any of that stuff. No. Okay, so then let's go ahead. Let's pull up Microsoft. Let's pull up Apple. And who else we want to pull up? Amazon. Let's pull up those three big dogs, right? All massive companies. Apple, 33 forward PE with, very low earnings per share growth. We'll see what happens next year. Analysts are probably too bullish on their numbers here. Revenue growth, maybe 8%, but we'll see if they even hit that. Apple, you can make an argument that's either fairly valued or overvalued. So you've got something there. You can't make an argument that Apple's in a bubble. That's not debatable. It's either Apple's fairly valued here or overvalued. I would lean a little more toward overvalued, but it's not like it's insane, like, oh my gosh, this is insane, right? I'd be loading up on puts on Apple right now if that was the case, right? Microsoft, forward P of 32, double-digit top line and bottom line growth in the SaaS space. Can't say that one's a bubble or overvalued. That one's either fairly valued or undervalued, right? I would say Microsoft's fairly valued here. Amazon, 37 forward PE. They're going to likely put up 20% plus earnings per share growth for years to go in the future with nice double-digit revenue growth year after year after year for as far out as the eye can see. Amazon's undervalued. So the only stock you could really make an argument with is Tesla, but Tesla always trades rich. I've never seen Tesla in any moment where it hasn't technically looked overvalued on a P basis, forward P basis, 2-year forward P basis. It's always Tesla, right? So what you got to go off of? Hey, we went through AMD. AMD is very undervalued right now, right? And that's a little guy compared to these companies. AMD's around a $200 billion market cap compared to a lot of these are like $1 trillion plus. You got nothing. So that talking point about, the big stocks are overvalued, no. If all of them stop growing, sure, then you can make an argument that they're too richly priced. But outside of that scenario, no.
Straight line up. If you look in the last 2 years, back-to-back years of above 25%, we've become conditioned that the market's just going to continue to move higher, thanks by and large to the Fed dovishness and their $7 trillion balance sheet. So I'm looking, I know Tom wants to back up the truck here. I have the truck running, but I'm not ready to back it up yet. I want to see this more process, reset valuations. I think that's going to be the next couple months, possibly the first quarter, because we've become too conditioned, Kelly, to markets repricing in a day. I have to go back to my 30-year career and understand that we will see reset valuations more of a quarter or two, not just a day or two.
Tom, this has
You can't really get a crash in this market right now because these big dogs aren't overvalued. The difference is when what you had essentially in 2021, right? If we go back to the end of 2021, let me go ahead and pull up. Let's pull up a stock chart here of these type of stocks in 2021 versus where they're at now. Now, what's the big difference between these companies and where they were valued back in 2021 versus where they're valued now, right? Well, one, almost all their revenues are substantially higher than they were back then. Same thing with their earnings per share and their net income, right? But additionally, and you got to consider this, back in it, here, let me pull up a chart here to really, illustrate this point. So if we go back 3 years ago here, what is that around here? So we need to go to somewhere around here, and then we need to add in Apple. Okay, let's add in Apple, and let's see how all these stocks have done over the last 3 years specifically. Let's add in Google McDougal. Let's go ahead and add in Amazon. Let's go ahead and run Meta. Who else we need here? We'll pull in NVIDIA, right? Let's pull in NVIDIA. And we'll just run with those for now, right? Big six. So let's see what's happened with those stocks over the past 3 years. So NVIDIA's up 332%, Meta's up 80%, Apple's up 39%, Amazon's up 29%, Google's up 27%, Microsoft's up 27%, right? Now, I can tell you all those companies' net incomes in 2025 are going to be night and day difference than where they were at back in 2021. I mean, a night and day difference. It's hard to even recognize for basically all those companies. But what you had was an interesting phenomenon that caused that actual crash, right? It wasn't just, the Fed's, raising interest rates and whatnot. And the other thing you got to consider that happened during that time period was during Rona, right? Which Rona years were obviously 2020, 2021. All those companies saw this crazy run in their revenues, right? Amazon certainly saw that. All the stimulus money being pumped out there, right? Everybody being forced to be at home. Amazon went crazy with their numbers. You saw that with Meta, Google, all those companies. So that was a situation we had, right? And then going into 2022, they couldn't replicate those numbers again in terms of that sort of growth. So all their growth rates all plummeted while they all way overhired for about a 5-year span that went from about 2017, 2018, all the way through that Rona time. Meta, all those companies way overhired. So you had a situation where all of a sudden revenues stagnated in a massive way for basically all those companies while their expense profile was insane, and it set up for this, honestly, it was a superstorm for those companies, and that's why their stock price fell off a cliff. Do you have that now? No. All those companies are running lean now. Additionally, they haven't had some crazy pull forward in demand. The only one you could potentially argue has had a pull forward in demand is NVIDIA, right? But NVIDIA, at the end of the day, like, these companies got to continue to order their chips and chips and chips for years to go in the future, right? So NVIDIA is the only stock that maybe you got an argument there. And that's the only one. The rest of them, you don't have that argument. It's not like Meta had some big pull forward in demand because everybody's forced to be home. No, or Amazon or Apple or any of these companies. So now their revenues are back to being much more predictable again, about double-digit earnings per share growth and revenue growth, right? And additionally, they haven't gone crazy with adding costs to their business. It's not like they're all out there just saying, let's hire everybody with a pulse that's an engineer like they were, years ago, right? So therefore, to get the market to crash is just damn hard. It's difficult. You need a black swan event pretty much to come out of nowhere. This is very, very different than the setup we had, several years ago.
Bit of a slide for the Dow, to put it mildly. We had 10 down days in a row. You say you saw signs of capitulation yesterday, as it was a 90% down day.
I did, Tyler. As context, the market has been bleeding lower. If you look at internals for the last 10 days, yesterday looks capitulatory because not only did we have a 90% down day, but the VIX, the spot VIX, exploded by 75%. There's only 4 times in history where it's risen 60% in a day. So yesterday was the 5th time in its 35-year history. Of those 4 times, the market recovered all of its losses within a week, 3 out of the 4 times.
So this is interesting. Okay. So VIX spiking insane. It did in 2007 there. It did August 5th, 2024, earlier this year, right? December, well, obviously yesterday, right? And then February 2018. So, yeah. But the one thing I'll push back on here is 2007. Obviously, that was before the great financial crisis, so that got messy, right? So that's something to consider. August 5th, everything turned out good there. Jury's still out on, obviously, what happens from here for us. February 2018, market started to come back very strong, but then we had drama for your mama at the end of 2018, right? Just something to keep in mind. But also remember, why did the VIX go so insane yesterday? Let's be very crystal clear about why the VIX went insane yesterday. The VIX went insane yesterday because no one was prepping for anything. Like, people have been very lazy with hedging. They felt like we've had a 2-year bull market. So when that happens, a lot of people start to say, screw hedging, like screw, buying puts on my portfolio and taking profits and those sorts of things. People have been very complacent. And so when people start getting very complacent in the market, they're not hedging, especially when we're talking big money, not hedging, not taking profits. And also you have something come out of nowhere like yesterday, right? Where people are like, oh my gosh, I thought the Fed was going to lower 4 times. Now they're talking about 2 times next year. Boom. Next thing you know, you get a massive, insane spike in the VIX. That's why that happened.
It took the 4th time, it took a month. So I think what you had was people panicking to get out of what they thought was a momentum trade that's ending because we're so close to year end. But here's the interesting thing. The forward VIX futures curve barely moved. So it was almost as if people were seeking protection through the VIX yesterday.
What tells you, Jeff, that more valuation resetting is to come?
I think due to the fact that we only had 1 down day, Ty, typically when you see prices reset or revalue, you have consecutive down days. And those consecutive down days bring along margin calls. And you saw Interactive Brokers talk about his concern of margin being used on the Mag 7. So when I look at a day like today where you're seeing passive indexes buoy the overall 3 major indices, NVIDIA, Facebook.
Could see it tomorrow.
These names are coming back because you're seeing people deploy cash in a passive index. So I do get concerned about that short-term volatility, but I'm going to embrace this volatility over the next month or 2 because I don't think history is going to line up. This is not going to be the same way. We've seen a straight-up move ever since last November, and especially since November 5th after the election results. So I do have...
Is the Russell even up on a 3-year basis? Fair question, right? Is the Russell even up? on a 3-year basis. Let's go ahead and add in IWM here. I'm not even sure if it's up on a 3-year basis here. Let's take a peek at the Russell. Nope, the Russell is technically down on a 3-year. And you think about everything in the world being so much more expensive than it was 3 years ago, right? And there the Russell is technically down on a 3-year. That's wild.
Short term, but I am cautiously optimistic in 2025. But there's going to be more volatility. This was like a depth charge that went underneath the water. There will be ripple effects.
Tom, let's talk about the small caps for a minute, because they have these kind of moments where they look really promising, they go on a tear, and then it just stalls out. And a lot of investors are feeling frustrated and wonder if it's worth sticking around.
Yeah, I mean, I'd say investors are tired of having like the rug pull on small caps. Yesterday's an example. Unfortunately, when markets get nervous and they're risk off, and of course buyers disappear, stocks that aren't as liquid get hit harder. That's why the Russell not only has been sort of under pressure for a couple of weeks, but really got hit yesterday. But do we think anything has undermined what makes small caps attractive the next 5 years? It's still in place. I mean, they've underperformed the last 10 years by the second largest magnitude in the last 125 years, except for 1998. So not only are they derated, but now we have a roadmap of deregulation, possible mergers, at a time when financials, which is a huge weight in small caps, look more promising, and things like biotech, which is a huge weight, also look more promising with deal activity. So I actually think this is, again, another chance to buy a dip.
Yeah, you know what's interesting is Tom Lee had a major call going on this year. Actually, his biggest call going into this year was that he was calling for small caps to have a beast year. He was talking about potentially 50, 60% upward move, right? And IWM's up like 10%. So, certainly that hasn't come to fruition, but he might have just been a little early. At the end of the day, I do believe if there's a pocket in the market I think is going to do very well under the Trump presidency period, I do believe the small caps will be that group, the Russell 2000 type stocks. So, I wouldn't be surprised. I wouldn't be surprised at this, actually. If we're going to look at from the day Trump gets in office to the day Trump leaves office, I would not be surprised at all if during that time period, the IWM actually is the best performing stock market index. I actually wouldn't be surprised. And that's kind of a crazy call, considering the Q's basically always beats every other market index over that time, right? But yeah, I wouldn't be surprised if the Russell actually outperforms them all during the Trump presidency. We'll see, obviously, where it shakes out. I'm not placing a bet on that, but I wouldn't be surprised.
To the University of Pennsylvania's Wharton School of Business, chief economist at Wisdom Tree. Good morning to you. I think we're all trying to make sense of this. Clearly, the market was caught off guard. I'm actually surprised that the market was caught off guard as much as they are, because if you watch our broadcast, to be somewhat immodest about it, I think Joe and Becky and just about everybody we've had on in the last week or two suggested that we may still get a cut, but we're going to get a hawkish language after that. And the market seems to think that this was some kind of great surprise.
Yeah, I agree with you. And it was exactly as I expected. I actually think it's a healthy development. Back in September when they lowered 50 basis points, I said two things. I said, first of all, the neutral rate is much higher than what the Fed has indicated. I think it's between 3.5% and 4%. I also said long-term rates were going up. I've said that on your program several times, and I think they're going to go up more. And that's not necessarily an unhealthy development. Do you know that for the first time in almost 3 years, the 10-year is above the Fed funds rate? And that's a normal situation. I mean, we brought the Fed funds rate. Powell brought it down yesterday, 4.33%. And as you know, we're 4.5% now on the 10-year. It's normal for long-term interest rates to be above short-term interest rates. We were 3 years in an inverted term structure. That's not an unhealthy situation. So we are actually normalizing the interest rate structure. You could call it recalibrating if you wish.
Right.
But long rates, I think, have a way to go further up.
Well, if that's your sort of base case, how do you think about equities from here?
Well, it's more challenging in 2025 than 2024. But don't forget, one of the reasons why interest rates are going up and why the neutral rate is higher is stronger economic growth. I mean, Powell mentioned that many times in the news conference that GDP growth has surprised on the upside. I mean, that's good for equities. It's bad for bonds, but it is good for equities. Now certainly, inflation has been more stubborn than expected. I still think there's, as he mentioned, some rental lags that I think are going to help us in 2025 get it closer to that 2%. But, higher interest rates don't necessarily mean a bad situation when they're caused by rises in productivity or rises in real GDP. And that's certainly one of the causes of the rise in the long-term rates.
But then do you look at yesterday or today and say this is a dip? Here's an opportunity, or do you say there's going to be a bigger dip?
Well,
I just don't know where this inflation is on a year-over-year basis. I'm looking at gas prices, national average, right here on my iPad right now, right? Regular gas is very slightly cheaper than it was at this point last year, right? So you're not seeing inflation in gas prices, which is something the consumer feels obviously very heavy because most people still drive internal combustion engine vehicles, right? So you're not seeing it there. Are you seeing it in rents anymore? No. Like I look at almost every major market out there, rents either are going down or are basically stagnant on a year-over-year basis, right? If, anybody's going up on rents right now, they're probably underpriced before, or it's a situation where they're just not accurately pricing in the market because almost all major markets and major cities I look out there, it's basically a stagnant or moving rents down right now. If we, think about auto insurance and insurance in general, you got something, right? But let's be very, very crystal clear. When it comes to things like auto insurance, homeowners insurance, medical insurance, I mean, those go up pretty much every year. Like that's just a way of life, right? So, and then you go further out than that, grocery prices have been much more just kind of like, I would say, stagnant on a year-over-year basis. You're not seeing a lot of grocery inflation on a year-over-year basis now, right? It's a lot of the same prices you were paying at this time last year as the prices you're paying, right? So, I mean, it's just like this whole inflation talk is just crazy now at this point in time. And technically, you're going to always see some level of inflation. Like, that's what always happens. Like, just welcome to the world. Like, everything gets a little more expensive over time. But the crazy inflation days have been long gone now.
There was a lot of trend followers, a lot of momentum players. I mean, they were on the train running up Tesla, many of the other Mag 7. Sure. That's not a healthy situation. All it takes is a little negative knock and whoop, they jump off the train. And sure. I prefer to see a market more dominated by fundamentals than momentum players just taking the ride. So I actually think market's certainly healthier today than it has been for the last few weeks where we saw a lot of momentum players.
How do you...
MU got hammered today, man. MU's not a bad buy here. It's not a bad buy. Like, it's never the most exciting company, but I'll say MU in the 80s is not bad.
Estimate, factor in... bet on what happens in 2025 to the economy, to the equity market in the context of the tariff conversation we've been having all morning, in the context of whatever you think tax policy is going to look like?
Yeah, I mean, I think that the tariff is the biggest question. And the immigration question are both big questions that are facing the market, but there's a lot of positive features. However, I don't think we're going to match the gains of 23, 24. I'm really thinking of 0 to 10% probably overall. I mean, I wouldn't be surprised to see finally value stocks break up more on the upside, and maybe the Mag 7 taking a rest from an incredible run. I don't think it's any sort of bubble on the Mag 7, but certainly to keep up 40, 50% gains is something that would be extremely against the odds for next year. So a bit of rotation, a quieter stock market, but still positive for investors.
Possible. All right, Palantir.
I mean, Diane, at one point, NVIDIA had the throne of the best performer. Palantir has stolen that and then some. I know we pulled back slightly this week, but it's still a phenomenal name as far as its yearly chart.
Yeah, and some of that pullback, especially when you think about yesterday, had to do with just overall broad market action. But today, Palantir moving higher off the back of some news that it has expanded its contract with the Army. The new contracts could lead to up to $619 million in terms of the expansion of that contract. It doesn't mean it necessarily would go that high, but it could be as much as that. So you're seeing the stock move higher by almost 5% today. You're right. It has been a massive mover when you think about the trajectory of Palantir this year, up more than 300% year to date. But that is one of the questions that analysts have around this, is the valuation question, right? Because where does it go from here? So as you mentioned, UBS has initiated coverage of Palantir. They've initiated coverage with an $80 price target, but they are hitting it with a neutral rating. They said, quote, our review of Palantir's fundamentals left us very positive. Customers and other checks were almost all bullish on Palantir's model. But the thing that is keeping it on the sidelines, as it were, is the stock's valuation. They said Palantir's valuation is, quote, simply tough to get over. We know that the defense sector is a big part of where Palantir gets its revenue from. It has been expanding within commercial, but again, defense has been its biggest money maker for Palantir, especially when you think about the AI platforms that it provides. It has been.
This is completely fair in my opinion in regards to UBS's note here. Valuation at 49 times revenue and 124 times free cash flow in 2025 estimates, simply too tough to get over. Fair. Like, as a Palantir shareholder, I agree. And I can understand why somebody wouldn't buy Palantir right now. The valuation is very, very rich. So, yeah. And that's why, as a Palantir shareholder, in my opinion, it makes sense to take some profits now, or just hold your shares. Like, to be actively buying, you're just not getting attractive pricing right now on Palantir. Doesn't mean it can't go up more in the short term. I don't know, it goes to $80 or $100 or whatever, but I'm just like, there's very limited juice to squeeze over this next, in my opinion, 2 to 3 years on Palantir. I hope I'm wrong. I would love to see it at 150, send it at $200, but I'm like, nah.
Was its bread and butter, but again, it's been expanding. So it looks like UBS sees the bullish case, but it's, again, given what has happened this year and the momentum behind it, it has questions about the valuation reaching much more from here.
Yeah, Diane, I think I hear that argument. The only problem with it is that it was basically as expensive as it had ever been pre-election, and the stock's basically doubled since that point to get even more expensive. So while the risks are very much highlighted by the valuation, it's really hard to time, and so keep that in mind 100%. As well. Other than that, seems like this is a company kind of clicking on all cylinders. Is that your thought?
Yeah, I mean, that seems to be the case in terms of its performance, expanding this contract of, again, what has been their bread and butter. But it's interesting to see the note from UBS because it does match up with some other recent analyst commentary. William Blair saw this contract coming, the extension of this contract, and seeing the value increasing. But they also point out that the premium that it trades at when you compare it to its peers, so they also have an underperform rating. They don't have a neutral rating. They have an underperform rating, and they say the potential for just that valuation, the multiple compression that we've seen in previous years, if you go back to 2021 or 2022, they talk about the risks to the upside. Even the incoming administration, they point out there could be some risks there. So to your point, Alex, although it did move higher, along with some just overall broad market action following the election, there is concern about, what new contracts would be extended under a new administration. Now, on the bullish side, you have analysts who do expect to see increased spending there with the new administration.
And I do think that's a great point there. That I see this name. I mean, there's an expected benefit of, more and more of this money pouring into the economy. If you're a believer of that new administration, I think there's a lot riding on that. But we will have to wait and see. And I do think unarguably so, Palantir now, best performer in the S&P 500 this year, is still one that's always going to warrant our attention, despite maybe its super high valuation, which is, I think, a fact at this point. But appreciate it, as always, the great breakdown from Diane King-Hall, senior markets correspondent for the network.
Yeah, there's absolutely no shame in the game in taking some profits on Palantir, right? And redeploying that if you see better opportunities in the market. Because Palantir at this stage, it's just not even close to being the best opportunity in the market over the next 2-3 years. I would call it a pretty high risk, pretty low reward opportunity for the next 2-3 years, in my opinion, right? And the reason being is you just push the valuation so far, right? 2-year forward P is 100 something on this stock, right? You could say even if earnings per share come in way better than anticipated, you're still at, let's say, 100, 110, 120. Like, it's not like it's a low amount there, right? And so there's a real potential they come in with 30% plus revenue growth in 25, 30% plus again in 2026. But even then, you're still running a very rich valuation on this baby. So yeah, Palantir, it's either, sell some shares, cash some shares, redeploy that money elsewhere, or just hold, and to buy here. Like I said, there's just a lot better opportunities now. And it's just very different than it was 2 years ago. I think Palantir is one of the best opportunities in the market to be buying 2 years ago, like I was, right? But now that ship sailed. That ship has sailed. So yeah. Alrighty, guys. Appreciate you joining me as always. Thanks so much for being here. Once again, main channel likely tomorrow will be covering Nike as well as some other subjects on that baby. Additionally, if you want to support my content, you enjoy what I do, you can click the pinned comment down there. That'll be to join my Patreon. Join 1,000 plus members in there. Get to see access to the moves I make every single week in the Patreon portfolio, as well as get access to that Discord chat that's in the Patreon as well. And if you want this tier, this particular tier also has my Become Master Stock Market course in it. And if you pay for a year, you actually get 16% off. So if you're a little more committed, you obviously get to save some there. Alrighty, guys, much love and have a great day.